Ever felt stuck between wanting to grow your money but also feeling scared to lose it? You're not alone. A lot of people hear the word investing and immediately think, sounds risky. But they also wonder, if I don't invest, how will I ever get ahead? That inner tug of war is what we're diving into today, risk versus reward, one of the most important ideas in personal finance. What is risk versus reward? At its core, risk versus reward is a balancing act. The more reward or profit you want to make, the more risk you'll usually need to take. And the more you want to protect your money, the less you're likely to gain. It's the engine behind almost every money decision, especially when it comes to investing. But here's the thing, risk isn't necessarily bad. It's just the possibility that things won't go as expected. Sometimes that means losing money. Sometimes it just means waiting longer, or seeing more ups and downs along the way. And reward isn't just about making more money, it's about moving toward your goals. Let's break it down with a simple example. Say you have £1,000 and you want that money to grow, but how you do that depends on what you're comfortable with and what you're aiming for. Option 1 is a savings account. Risk is very low, reward is also low. Maybe you will potentially earn £30 to £40 a year. Savings accounts are insured and stable, but interest rates are usually low, often lower than inflation. Now let's go to option 2, which is investing in the stock market. Risk is higher and the value can fluctuate day by day. Reward is potentially higher returns over time, maybe above 10% per year on average if you're invested broadly, and for the long term. By investing in stocks means you're taking on short-term uncertainty in exchange for the chance at long-term growth. The difference? Trade-offs. In the savings account, you're avoiding the chance of loss, but you're also missing out on meaningful growth. In the stock market, you open yourself to more ups and downs, but also greater long-term potential. But not all risk or reward is equal. Not all investments carry the same level of risk or potential reward. There's a whole spectrum ranging from super safe to ultra risky options. For instance, government bonds are considered low risk and offer lower returns. They're generally safer than stocks, but might barely keep up with inflation. Index funds might land somewhere in the middle, offering moderate risk and reward by spreading your money across many companies to reduce volatility while aiming for steady growth. Each investment also brings its own type of risk. Market risk involves the possibility that the entire market will rise or fall. Inflation risk is the danger that your money won't grow fast enough to keep up with rising prices. Liquidity risk involves the danger that you won't be able to access your money when needed. And emotional risk, often underestimated, can lead to poor decisions driven by fear or greed, like buying high and selling low. Understanding the kind of risk you're taking is just as crucial as knowing how much you're taking on. So, what is smart investing? Smart investing isn't about chasing hot stocks or trying to time the market just right. Instead, it revolves around 3 core principles. First, know your goals. Are you saving for retirement 30 years from now, or for a house in just a few? Second, understand your time horizon. The more time your money has to grow, the more risk you can generally afford to take. And third, find the right balance between comfort and potential. It's perfectly fine to be cautious. The key is choosing a level of risk you can stick with, one that won't leave you stressed or sleepless. A common pitfall is going all in on so-called safe investments, only to realize years down the line that your money hasn't grown enough to reach your goals. On the flip side, some people jump into high-risk assets, then panic and sell when the market takes a dip. Smart investing is about avoiding both extremes and building a plan you can live with long-term. Why does it matter in real life? Let's talk about inflation. If your savings are earning 3% interest, but prices are rising at 4% a year, you're actually losing money in terms of what your cash can buy. It might not feel like a loss, but over time your purchasing power shrinks. Your money buys less and less. On the other hand, going all in on high-risk investments without a solid plan can be just as dangerous. A market downturn could wipe out savings you were counting on in the near future. That's why understanding the balance between risk and reward isn't just financial theory. It's a practical tool for making every money decision. It helps you weigh the potential upside against the real-world consequences, keeping your financial goals in focus. Think of your financial journey like crossing a river, with several bridges to choose from. One is thick and sturdy, solid underfoot, with almost no chance of falling. It's the slowest route, but it feels the safest. That's your savings account or a government bond, steady, reliable, but with limited growth. Then there's the narrow rope bridge. It's quicker, but it sways. This is like investing in stocks, offering higher potential returns, but with more ups and downs along the way. And finally, there's the shortcut. A zipline with no harness. It's thrilling and fast, but incredibly risky. That's speculative investing. Things like crypto, options trading, or jumping into trendy startups without doing the research. There's no universally right bridge. The best choice depends on your destination, how quickly you need to get there, and how much risk or wobble you're willing to tolerate along the way. The real takeaway. Every financial decision involves trade-offs. Playing it too safe might give you peace of mind today, but it could mean falling short of your goals down the line. On the other hand, taking on too much risk without a plan can lead to quick losses, especially if you're not emotionally or financially prepared for the swings. The key is finding your personal balance. Ask yourself, what are you investing for? How long can you leave your money invested? And how much risk can you handle without making emotional, knee-jerk decisions? Risk versus reward isn't about being brave, reckless, or hoping to get lucky. It's about being informed. It's about crafting a strategy that fits your life, your timeline, and your comfort level, not someone else's. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.